name's Colin Godfrey. I'm fund manager to Tritax Big Box REIT. Thanks very much for joining us today. Thanks also to Numis for hosting this interesting conference by webinar. And also to Kevin for a fascinating opening to the webinar. Much of the themes that Kevin raised are also echoed in our own presentation, so apologies for any repetition. We've been asked to make a brief presentation today on the big box sector of the logistics market in the UK. And this should take around 20 minutes, following which we'll take questions. I'm joined by James Dunlop, who's head of our investment side for Big Box. James will open by looking at the effect of COVID-19 on our market. He'll touch on rent collection and sectors affected by the pandemic. James will then cover some fundamental drivers to our market and its potential for growth. And then I will look at the supply and demand characteristics before we close with a brief outlook. James, over to you.
Thank you, Colin. Good morning, everybody. What I think is in no doubt is that the UK's logistics sector is underpinning how the UK economy continues to function through this crisis. But there are plates of change spinning within the sector itself. We have learned that there is a clear demarcation between those sectors and operators currently benefiting from the effects of COVID and those that are suffering. COVID has accelerated the business plans of the winners and has accelerated the demises of the losers, particularly those retailers with a heavy bias to physical retail and with legacy formats. The winning sectors we all know about, but just to reiterate, are pure online, food and groceries, homewares and DIY, and the third-party logistics companies currently bolstering the capacity of these former three sectors and other online selling platforms. It is interesting to note on this slide to see some of the recent comments in the press. This is Money's view, is that most people will maintain their new shopping habits post-lockdown. Why wouldn't they? It's more convenient, it's probably cheaper, and behaviour scientists suggest that it takes around 21 days to establish a habit, and we've been in lockdown for 35 days. B&Q reported a 125% increase in online sales, with an incredible 300,000 people an hour waiting online to get into their website. Ocado, as Kevin mentioned, reported 10 times more demand for their services before the outbreak began, and it had to close its order book at that level. If they'd had more capacity, they would have secured even more new customers. But only a fully automated robotic model can cope with a 10-fold surge in demand. This could not have been achieved without their state-of-the-art big box we funded in Erith in 2015. A similar story, an extraordinary one, with Amazon's grocery orders increasing 50-fold since the lockdowns began. Another theme in our market emerging is the rise of new partnerships. These were probably already in the offing, but the crisis has accelerated them. Morrison's, Co-op and M&S have teamed up with Deliveroo to deliver food to your door. Amazon, Royal Mail are helping the government distribute virus tests and protective clothing. The list goes on. And it's the online machine driving all of these changes across our sector. This crisis has accelerated the adoption online. The millennials were already on board, but even those who were resisting it pre-crisis are jumping on board now. For example, my 80-year-old father sent me an Easter egg bought online. I've no idea how he managed it, but he did. And then yesterday he followed up by sending me a book, a game changer for that generation. The next page, this slide shows the breakdown by sector of the contribution to the portfolio income of Big Box. By handpicking each asset, we've curated a well-diversified portfolio dominated by the key sectors that are winning: online, food, homewares and DIY, but also electricals and the third-party logistics, which are proving so resilient to our income and to our sector at large. The logistics sector performed well in terms of its rent collection. If you look on the right-hand side of this page, receipts for Q2 when compared to other sectors, retail booking just over an average of 50%, industrial and residential in the mid-70s, offices at 80%, and Big Box 90% will be in by the end of May. But we suspect the next quarter will be the tougher one for all of us, particularly for those portfolios with income secured from SMEs, operational occupancy related businesses, the restaurant trade, travel or hospitality industries. The Big Box sector will not be immune, but with some of the strongest balance sheets in the UK economy paying our rents, we hope to repeat the resilience of Q2, but we will see how that pans out. The next page, this one shows the statistics from the ONS comparing UK online sales and penetration rates for March 2019 and March 2020. But it's important to note, but we must remember we were only really in lockdown for 7 days of March. so the stats only really capture about 25% of the picture of that full month. But as you can see from these bar charts, the stats start to document the enormous leap in growth. All food up 21%, non-food up 18%, like-for-like sales growth for homewares and DIY up 55%. The UK will probably have the whitest windowsills and wonkiest garden fences in Europe post-crisis. We cannot wait to see the April numbers when they're released, because there'll be more trajectory of an upwards curve. My next page, page 6, everyone's aware, of course we are, of the strong online growth over the last decade, rising to 19% of total sales in 2019. The key question, which we're all trying to wrestle with, is where can it rise to and at what rate? The graph to the left depicts pre-COVID. A number of forecasters were suggesting it could hit or exceed 50% by 2020. The blue line adopts a more conservative scenario of growth to 30%, which feeds a requirement of an additional 65 million square feet of logistics space. But if online sales represent half of all retail sales, the higher purple line, then that total rises to 155 million of additional space. On the right, the graph is our views. We've seen, post-COVID, we've seen a dramatic acceleration of the pace of online growth. The previous slide that showed in the first 7 days of the lockdown at the end of March, 19% grew alone in 7 days to 22.3. So what could it be now after nearly a full month of lockdown? 25%, 30%? Kevin mentioned 40%, excluding the grocery sector. It could be more. The key is we all know it's significantly higher. And it is our view that when we ease out of COVID, there'll be a more permanent migration from bricks and mortar retail to online. Many retailers will have lost their customers unless they can recapture them online. And to do that, they will need more big box logistics space and last mile space. By June or September, i.e. in 3 to 6 months, we will probably have turbocharged growth levels, which would have taken pre-COVID 5 years or more to achieve, and would have done it in 3 to 6 months. If we stabilise post-COVID at, say, a conservative 30% of total retail sales being done online, our already undersupplied occupational market will be demanding an additional 65 million square feet of logistics space by the end of this year. Positive. I will now hand you over to Colin.
Thank you, James. The last slide covered by James looks to the future. But what can we learn from the past that helps form our view of the future? The first thing to say is that the logistics sector is relatively young. It emanated from the former industrial estates, and post-millennium has increased dramatically in its sophistication and impact on our lives. Back in the 1990s, some of the largest buildings in the UK were around 300, 350,000 square feet, often single height facilities. But since then, building sizes have grown substantially, with ground floor areas pushing 1 million square feet and eaves heights up to 30 meters, providing the potential for several mezzanine floors and several million square feet of space, and in turn providing flexibility, of course. Logistics has grown in importance, has become increasingly complex. Buildings provide different functions in the supply chain, and this is evidenced by the language used to describe building functions, from mega warehouses to smaller last mile facilities. Much of the market supply and demand data is bundled up and reported for buildings of over 100,000 square feet, as Kevin mentioned in his presentation, even though these properties can be very different in size and in function, again touched on by Kevin. The language used can therefore potentially be misleading. And this is something that the property profession needs to improve upon. On a number of occasions recently, we've been approached by investors concerned at market rumour that there's been a marked increase in speculative supply of big box logistics assets, believing that these relate to the larger scale buildings. The facts show the opposite's true, with speculative development of larger scale logistics reduced by around 50% in 2019. The page we're on here focuses on larger scale logistics of over 500,000 square feet. The left-hand graph showing that speculative supply of larger scale logistics over the last 4.25 years, since the beginning of 2016. And this shows that there have been only 8 speculatively constructed buildings completed since that time, totaling 4.3 million square feet. And of these, only 2 remain available today, totaling 1 million square feet. To put these numbers in perspective, total lettings in this size band over the last 4.25 years been nearly 44 million square feet. Speculative supply has therefore constituted less than 10% of take-up. Turning to the graph on the right, we're looking at the nature of lettings. What we note is that the second-hand space is limited, largely because the larger buildings are typically modern and in demand, but also because larger scale buildings tend to be built to suit. In other words, they're typically built following a pre-letting. This doesn't mean that they're bespoke. In fact, they're almost always designed for generic appeal. The takeaway here, however, is that the majority of supply for larger scale logistics is being absorbed by design and build demand. On this next slide, we focused on comparing the data for the different size categories of buildings. We're of the view that the full range of logistics property sizes are attractive, and we have in-house capability of delivering buildings in all these size bands following our acquisition of DB Symmetry. But we also believe that the larger scale buildings have some very attractive attributes. Firstly, can't have the last mile without the first mile. The larger scale buildings are usually a critical component in the supply chain. We've noted that significant levels of automation are rare in small buildings, which tend to handle lighter, faster moving products. Automation can be very expensive to install, as Kevin mentioned, the cost of which is typically paid for by the tenant and amortized under their accounts over a long period. The importance of the building within the operations of the occupier is also reflected in lease length. And we've noted a relationship whereby smaller buildings are typically let for shorter lease terms compared to larger buildings, which can attract leases of up to 30 years. Perhaps most importantly, there is also a correlation between lease length and tenant covenant, with the more financially robust companies attracted to larger scale logistics hubs. So with that in mind, in the left-hand graph, we've looked at market activity, combining take-up with the buildings under offer at the year end to form an impression of demand. What we find is that larger scale logistics buildings have been responsible for an increasingly large share of market activity in each of the last 4 years as a percentage of the total, rising from 35% in 2016 to nearly 50% in 2019. This compares with smaller category buildings, which have been responsible for a decreasing share of demand activity. The 2019 figure also includes over 8.8 million square feet of buildings which were under offer at the year end. COVID-19 has clearly slowed lettings, but the Q1 take-up numbers are impressive, with over 4.9 million square feet in 5 larger scale logistics buildings let since the turn of the year. The right-hand graph looks at supply by size band, with the y-axis denoting the amount of space as at the end of each of the last 4 years to the end of 2019. The amount of supply is also shown as months of supply in the small bubbles you can see there, compared to the run rate of take-up. In other words, 12 months of supply would suggest supply and demand parity. Notably, the supply of smaller buildings proportionate to demand has been rising, whereas for larger scale buildings, this has remained relatively low, and at the end of last year constituted only 1.4 months worth of supply against 12 months worth of demand, the shortfall being met by pre-lets. Developers are seldom willing to speculatively risk the capital required to construct very big buildings in a single location. When demand is strong, they prefer to wait for a pre-let. They're more comfortable speculatively constructing smaller buildings in a geographically diverse nature. This is borne out by the data. The smaller 100 to 250,000 category, there was 9.3 million of speculative development in 2018, of which 2.9 million was let in that year. And in 2019, 56 logistics buildings were speculatively developed, totaling 8.1 million square feet. So a slight downtick, of which 3.4 million was let during the year. So leaving a fair amount of space unlet. So what does all this mean, and how do we interpret the backdrop of our market and the opportunities looking forward? And there are clearly opportunities and threats. The near term being of less clarity in our view. So I think the first thing to say is that logistics property looks to be the most resilient of all commercial property sectors during COVID-19, underpinning the continued operation of the economy, delivering higher rent receipts and maintaining more stable asset values so far. COVID-19 has accelerated the growth of online adoption with increased penetration across all ages and demographics, as James mentioned, and habits are likely to stick with healthy levels of increase being maintained in a normalised market. There's likely to be a near-term lull, but post-COVID, we expect to see increased levels of occupational demand from occupiers for many of the reasons mentioned by Kevin. Larger scale logistics have been responsible for an increasing share of demand activity, and we expect that trend to continue as occupiers strive to benefit from economies of scale, reduced costs of unit per sale, and maximising capacity. Brexit and COVID-19 are expected to reduce reliance on overseas product sourcing, and that was a point that Kevin mentioned, and increase self-reliance, resulting in increased domestic demand for production and warehousing facilities within the UK. And this is something that we're already seeing coming through in the language from occupiers in our portfolio. COVID-19 has highlighted an additional benefit of automation, with lower staff interactions, allowing businesses to continue operations during lockdown. We expect continued investment in automation in order to capture operational efficiencies, improve stock control, and optimise delivery times. And with a UK recession now likely, investors are seeking resilient sectors with modest capex commitments, low LTVs with an attractive cost of debt, and high quality, reliable income. Despite the near-term uncertainty, the outlook for our sector is incredibly positive. An increase to 50% of online sales will result in an additional demand of over 150 million square feet purely from e-commerce. We see the potential for strong demand-led growth, both occupationally and from investors. And against this, supply will continue to be constrained due to planning, benefiting those with advanced land platforms. That concludes our presentation for this morning. And I'll now hand back to Justin, who can handle the questions.
Thank you, Colin and James. Just to keep the questions coming in, please, on the Q&A function. Just something I thought was interesting, you mentioned, James, about the relatively young age of the sector, you know, certainly in your space. How do you seek to deal with the pace of kind of innovation and changing occupier demands, you know, in aspects such as automation, you know, in your business model?
I mean, really, our model is very simple. It's a relationship-driven model on all levels of our counterparties, but in particular, it's the tenants. So we spend a lot of time sitting down with our tenants, fully understanding their model, fully understanding what their aspirations are, what they're trying to achieve through their logistics supply chain, what they're trying to achieve through a big box in a certain location, and what goods that they are servicing through that unit. And so, you know, the automation model is not relevant really to certain sectors, mainly those that are moving around very large items. But the smaller the item, the more relevant, I believe, automation is to those tenants. So really, in essence, we try and understand our occupiers' models and then we try and understand how what they intend to do within our buildings. If you remember, most of the time we own the fabric, the walls, and the hard standing and the land, and the internal guts of the building. We monitor what they're doing, but it tends to be a tenant's cost. But we will help in the construction to ensure that those particular bespoke automation systems can fit. But we're also very conscious that they can also be taken out without destroying value. So, in essence, we listen to the occupiers, and that's how we feel our way through the innovation.
Great. One in from Alistair. How do you see the financing and capital markets reaction to this current crisis? Do you see a slowdown for a short period? Is the lending environment still going to be there?
Yeah, it's Colin here, Justin. I think we've seen some concern expressed by borrowers wondering whether or not the banks are sufficiently well capitalised. Our research suggests today that they are. We have seen some companies move to draw down revolving credit facilities. I think we are already seeing an increase in margins. I was talking to some of them, they were suggesting that Ambridge lending costs are increasing by way of example. One doesn't know how much of a short-term issue this is going to be. I suspect that what will happen is that, that those banks which are particularly exposed to the SME sector, and depending on how long COVID impacts on the economies, some of those banks could start taking losses. That will affect their profitability. That's going to put pressure on them. Despite obviously bond rates being particularly low, so there's going to be quite an interesting situation that's going to occur there. And I think as a consequence of risk increase, we might see some lending propositions costs increase. But generally speaking, I think that the higher quality propositions are going to remain very appealing to banks, and that's where you're going to see a greater degree of liquidity in terms of available debt.
And Colin, on the capital market side, on the investment market side, I think there's no doubt that we're in a period where there's going to be very little activity whilst people concentrate on their own portfolios and their own operations. But I mean, pre-COVID, logistics was the most sought-after sector in the UK and probably Europe. I think post-COVID, once we come out of this period, it will probably be, again, the most sought-after sector, because income will be even more sought after, secure income, robust income that is not being disrupted under one of the greatest stresses and strains that this country's seen in the short term. And I think that will attract a premium value in terms of uninterrupted income. So we don't know how long the lull will be, but we know that the demand for the sector will remain strong.
Great. And I guess on the subject of security of income, question from Scott. Are there any no-goes within a tenant's business model which you'd avoid doing business with them? And has this changed recently?
Don't really quite understand the question there in terms of no.
I suppose it's asking in terms of when you kind of are looking at counterparties and tenants. Are there any sectors you'd avoid, any kind of red flags in their model?
Yeah, well, I think obviously what we're learning from COVID, which we're hoping to be a short-term situation, is that there are more fragile sectors. I mean, we didn't see this coming clearly, but we did see trends in the market, which is one of the reasons why we look to resist certain overexposure to certain sectors, particularly fashion, retail, and high street exposure. It's no coincidence that we moved our portfolio to provide a greater degree of exposure to online, food, homewares, and DIY. They're our three biggest component parts, and also the 3PL. So we're pretty well positioned in this market as a consequence of those which are performing particularly well and seen an uptick in sales compared to those which have seen a downturn. But I think that what this is doing is it's exposing underlying fragilities, particularly regarding balance sheet strength of some of these companies. And I think the danger, of course, is when a market's on the up and people are chasing yield. The danger is that you're prepared to accept lower quality, both in terms of real estate, modernity, location, and indeed in terms of tenant caliber. And that's something we've been very, very keen to avoid, which is one of the reasons why we moved to the DB Symmetry model to create our own product moving forward, so that we could control the quality of the tenants that we're prepared to accept. And we've been very, very careful to ensure that when we don't have a totally bulletproof tenant roster, but we've got some fantastic tenant names in there, which we're confident will remain resolute throughout this pandemic.
And without naming any names, have any of your customers come to you with requirements for new space?
Yes.
Okay.
Probably in the sectors that we suggested might be winning.
Yeah.
I mean, it's really fascinating. The 3PL, obviously the 3PLs are being used for overspill. We're seeing the existing customers with what we saw previously as being several years potentially of expansion space. That's being used up very, very quickly. The 3PLs are being used, as I said, for overspill, and they are now pretty well being maxed out. So I think we'll see some of the higher caliber second-hand space being taken up by the 3PL sector, particularly if the rents are at a good level. And clearly there will be some losers. I think the key thing everyone needs to remember here is that the weaker businesses are likely to hang on. I mean, partly given protection by the government, it's going to be a stay of execution for some businesses, and we might see more failures in 2021 than in 2020. So the effects of this pandemic are likely to be lasting much, much longer than the pandemic itself.
Great. And then we also talked about the capital markets, which is possibly related, but you want to talk about the kind of barriers to entry? Obviously, you guys have got your development arm now. How easy is it for someone else to come along and throw up a big box?
Yeah, I'll probably sort of double tag on with James on this. I think the first thing to remember is that the development process in the UK is highly constrained. It takes up to 10 years to bring. I mean, the first thing to say, these mega sheds are typically only really capable of being accommodated on a large field, farmer's field, very crudely. It has to be the right location. It has to have good communications access with access to motorway network or A road, etc. It's not an easy thing to deliver. The power capabilities requirements are increasing all the time. So if you're able to tick all of those boxes in relation to a location, then you've got to get planning on it, and that can take up to 10 years. Yes, there are ways of fast tracking that, but it's not easy. You certainly can't deliver it in a short time frame. And in fact, what people tend to forget, actually occupiers often come along asking for an immediate solution, and their agents are then essentially telling them it's going to take several years to deliver and be operational, particularly if they're going to be automating the building. So it takes quite a lot of forethought. What we've noted is that there's been a significant level of the land that had planning that's been taken up. There's not much left, and you've got a number of well-known developers who should remain nameless that are paying very, very high prices for land. And the reason is that they can see immediate requirements in the market and near-term demand, and they're looking to provide product into the face of that. Now, coming behind that, of course, we will need more land coming forward, and it's really important that we can continue to deliver a new product into the market to meet that future demand requirement, as we've mentioned, but in a controlled manner. And that's what we've consistently seen in the past. And the reason that is important is that it will continue to underpin attractive levels of rental growth, but not at an unsustainable level. At a level, yes, hopefully, and we expect to be ahead of inflation, but at a level that doesn't run away with itself and become unsustainable against the platform of underlying economic growth, RPI, CPI, predictions.
Great. Well, so a couple more questions. Maybe we can answer them very quickly just before we move on. But one of them you might not be able to say much on. What is the impact on valuations you're expecting in the shorter term, kind of 2020, 2021? time frame?
Just very quickly on that, we've been speaking to our valuers. I mean, no one knows. As James mentioned, we've seen some investment transactions going through. I think what we are expecting and what we're seeing right now in terms of a tone is that mega prime, the true prime end of the market, we're currently seeing values holding up. I think as you move through to fringe prime, secondary, and certainly tertiary, where you've got greater SME exposure, etc., there's a higher likelihood for yield softening. James, any further advance on that?
No, I mean we don't know, but what we do know is that the logistics sector is probably going to be the best performing capital market sector and valuation sector in going forward. We don't know how the valuers will react. There will probably be a sentiment-driven movement or caveat in relation to all sectors, all income streams. But I think the logistics sector will be in the best possible place with that backdrop. But it's too early to see what the market evidence is, where valuers will really want to hang their hat on, and there is very little that's relevant right now.
Yeah, and so finally, are you seeing any reaction from government through easing of planning regulations in urban and greenbelt zones to support logistics?
Too early to tell, I think, really, Justin, on that. Yeah, I mean that's to be said. I mean the councils are still grappling with trying to hold meetings on remote platforms, such as we're achieving very successfully here today. So we're going to have to see how that one pans out. I mean, it's really interesting, isn't it, that the government has tried, for a long time now to simplify and ease the planning process. And then when it gets down to local government level, it seems to get sort of stuck in a quagmire. So look, don't hold your breath on that one.
Brilliant. Well, conscious of time, thank you very much, Colin and James. Really interesting. Appreciate your time.
Thanks everyone for joining.